the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're listening to Money FM 89.3. Time now for Market View with me, Chua Tian Tian. We take a look at how Singapore markets close for the day, the biggest movers, sectors and companies to watch. But as always, a quick recap of how we started. Well, Singapore shares began the day in the green today, and in early trade, the Straits Times Index was up 0.2% at 3,829 points after nearly 25 million securities changed hands in the broader market. But as we told you earlier, the STI ended in the red, so let's take you through the closing numbers. Well, the STI closed down 0.2% at 3,815 points. In terms of value turnover, we are looking at 1.01 billion Sing dollars. Gainers trailed losers 247 versus 260. Top advances for today, we've got here iFast, Asus and Venture Core, and top decliners, we've got here GMXUSD, Jardine Cycle and Carriage, and New Incorporation USD. Now, in terms of counters to watch, we have for you Keppel, because Keppel recorded a profit of 528 million Sing dollars from its continuing operations for the second half ended December. Now, elsewhere, from the US Postal Service suspending inbound parcels from China and Hong Kong to disappointing reports from Google parent Alphabet and AMD. We've got more international and corporate headlines in focus. And joining me on the line today is Eddy Loh, Chief Investment Officer at Maybank Group Wealth Management. Eddy, welcome.
Hi, Tian Tian.
Great to have you join us. And Eddy, let's start with the U.S. this time around. We've seen the US Postal Service saying that it will temporarily suspend inbound parcels from China and Hong Kong. We've also seen how China placed Calvin Klein's owner, PVH, and U.S. gene sequencing company Illumina to a so-called blacklist of entities. How would you read into the latest movements? Some market analysts, they were saying that China's approach was more measured than expected. What do you think, and how is Wall Street reacting to growing trade tensions?
Right. I think Trump imposed 10% tariffs on all China imports. While he did pause the tariff action on Canada and Mexico, he was initially going for 25%, but he decided to pause that action. In retaliation, we saw China announcing up to 15% tariffs on some U.S. products, as well as other retaliation, including an antitrust investigation on Google. And I just saw that they are considering to conduct a probe into Apple's App Store practices as well.
Yeah.
So the escalation in trade tensions, I think, has weighed on equity market sentiment, led to higher volatility. Markets were choppy. Currency front, we saw the dollar index initially spike after the tariffs were first announced, but it's actually now back to the same level. For us, I think the next key date could be 1st of April, when Trump is expecting reports on a very comprehensive trade policy review, including how China has complied to the first trade deal signed during its first term. To recall, Trump was imposing tariffs on China in July 2018, which lasted for about 18 months before he reached a phase one trade deal with China. So I think should Trump administration be satisfied with the findings, there could be additional tariffs. But on the China front, some said that China is somewhat being measured in the retaliation or restraint because there's more to lose, especially given its domestic economic challenges. If you look at the goods, the total value of U.S. goods facing China tariffs is estimated at $14 billion, which is much lower than the estimated U.S. $525 billion worth of Chinese goods tariffed by the U.S. Right, so I think it does suggest some willingness on China leaders' part to engage in conversation and strike a deal. And as for Mr. Trump, I think he has warned Americans of short-term pain in trade war. However, I think he's still likely concerned about the negative impact of tariffs on U.S. growth and inflation. So at the end of the day, I think a deal will likely be eventually reached, although it could be a bumpy ride before we reach there.
Well, in Asia, at least for today, Shanghai, which reopened after that week-long Chinese New Year break, and Hong Kong, they were among the main losers. E-commerce firms in particular took a hit from the news of the US Postal Service suspension. Hong Kong down 1.2% earlier, JD.com sinking more than 4%, Alibaba down more than 1% then. How significant is the US Postal Service suspension on China's e-commerce sector for now? And as you said, a deal might likely be reached. So for how long can the negative mood on China's e-commerce sector persist?
So when Mr. Trump ordered the tariffs on the Chinese goods, I think one of the key things here is that all goods, it included all goods, including previously parcels, lower value parcels that were exempted from previous tariffs. So for now, with this new change, parcels that are less than 800 apiece are actually now being required or subjected to tariffs and to customs inspections. And what we understand is currently the U.S. actually imports close to 4 million of such lower value parcels a day, with little or no customs inspections or new duties collected. Right, and most of them are coming from China. So I think with the rollout of these Chinese tariffs, I think it gives them very little time to prepare in terms of postal inspection to scrutinize so many parcels at one point. So while the postal services has not really said and given a reason, we suspect that they may need some time to sort out the inspection logistics, and so the suspension may last until they can work things out. But having said that, Trump could change his mind very quickly. He could decide to pause the tariffs like what he did for the Canadian and Mexico goods.
Yeah.
But we never know, right? So for the time being, the delays will affect the Chinese e-commerce companies, especially those with higher revenue exposure to the U.S.
Okay. Well, going back to the Singapore stock market as usual, Eddy, how did the STI fare today in relation to global market movements? Started out somewhat healthy, ended in the red. So any surprises when it comes down to the biggest movers and the sectors that they lie in as well?
I would say that the STI has been holding up relatively well amidst all these trade tensions and market doldrums. So down 0.2% slightly, but remaining above that 3,800 mark. Banks were, I think, the culprit. They were overall lower and caused a drag on the overall market. But we did see selected industrial stocks as well as REITs outperforming, clocking in positive gains on the back of, I would say, pretty robust earnings announcements.
Okay. Now, if you're just tuning in, we're now in conversation with Eddy Loh, CIO, Maybank Group Wealth Management. Well, Eddy, zooming in on some of the companies to watch on the SGX, we have Keppel Core. Keppel Core, they're recording a profit of 528 million Sing dollars from continuing operations for the second half ended December. Now, Fraser Logistics and Commercial Trust, Capital Land Integrated Commercial Trust, they also released some operational and financial numbers respectively. I know you don't comment on specific companies, Eddy, but looking at the numbers out so far, how's the latest earnings season shaping up, especially when we look ahead to another heavy week of earnings next week?
I would say that it's still early days in the earnings season, although there are some encouraging signs of the recent announcement, as you mentioned, the companies Keppel, Fraser, Capital. I think the results were pretty decent, and I think we saw some positive performance in the share price today, or in terms of market reaction. For us, I think the key focus will really be on the banks. For the upcoming earnings season, with the sector being an heavyweight in the STI. And our expectation is that the sector should be seeing positive year-on-year growth with support from resilient wealth management income as well as net interest margins. And we do expect asset quality to remain benign as well. And one of the key things that investors will be looking out for is really on capital management. And there are thoughts that with the management focusing on optimizing balance sheets, that could be potential upside from dividends and share buybacks. Now, and apart from the banks, we also favor the industrial and telecom stocks selectively. Notably, banks, industrials, these sectors could also benefit from the recent signing of the Johor Singapore Special Economic Zone. And apart from these sectors, I would say selectively Singapore REITs. There are also some value to be picked up, especially where the dividend yield is still pretty attractive as a whole, on average in excess of more than 6%.
I see. Well, Eddy, from Singapore, let's take a look at what's going on in the region. Eyes are on Japan because Japanese nominal wages, they rose at the fastest pace in nearly 3 decades since 1997, I believe. That supports the Bank of Japan's latest rate hike decision, and that keeps it on track for further tightening steps. But Question for you is, what do you think really is next for the BOJ amid the current macroeconomic environment? And how did investors react to the latest numbers when it comes down to the yen-dollar pair?
If you look at the latest wage numbers, 4.8% year-on-year in December, that was actually higher than the estimated 3.8%. And the earlier December CPI was also above expectation at 3.6% on a year-on-year basis. So this combination of higher wages, higher inflation, I think that is actually driving expectations of further rate hikes from the Bank of Japan. And this is probably the key reason why we are seeing a stronger yen today. Now, the Bank of Japan has hiked rates in January and as expected, and notably the central bank also upgraded the CPI forecast to above 2% for the next 2 years, right? And what we are watching for is really on the upcoming Shunto wage negotiation to see if we will see a repeat of last year's 5.1% or more, right? And if that continues to pan out, then the central bank should continue to, I would say, normalize policy, because at this juncture, policy rates are still very low at 50.5%. So we are expecting BOJ to hike rates by another 50 basis points to 1% by the end of this year. And because of that, dollar yen will likely move lower. Now it's about 153. It should break below the 150 mark, more closer towards the 150 with the further normalization of BOJ monetary policy. The key risk to our view, though, would include the external uncertainties, especially with the Trump policies, and that could potentially lead to a delay in the BOJ normalization of monetary policy.
I see. Well, Eddy, I've got about 2 minutes to go, and I really do want to take some time with this one. And that has to do with earnings out of Google parent Alphabet and chip maker AMD. Now, if we look at Alphabet, it slumped close to 8% and extended trade on the back of a cloud revenue miss. AMD, even though it topped fourth quarter overall revenue estimates and provided solid forecasts for the current period, it released a disappointing outlook for its data center business, which overshadowed all the other results, sending shares down over 8% in extended trade. What does it say about the risk of having investors rely on big tech firms to drive up the U.S. stock markets? And is a market correction coming soon when it comes to tech stocks?
Right, I'm getting this question quite a fair bit from my clients as well.
Yeah.
So while some of these big techs, as you mentioned, have reported disappointing results, others, such as Meta, have actually reported positive earnings, and we do still have some other companies like Nvidia and Amazon, which is reporting today soon. But overall, I think more importantly, if you look at the 4Q earnings from the S&P 500, including the non-tech sectors, they have been pretty robust. About 77% of the companies have delivered a positive earnings surprise. So no doubt, S&P 500 market valuation is not cheap, and then obviously Trump policies is also inflicting or causing some short-term volatility. But we do expect overall earnings growth to remain healthy, and that should actually continue to support market returns. But I think importantly, we need to recognize that the growth contribution will broaden beyond the big techs. And we'll get growth contribution from other sectors such as the banks and as well as the industrials. I think notably, if you look at the banks' 4Q earnings, they have been pretty strong. And we think that the Trump's proposed deregulation will be positive for the sector. It could help to release excess capital to improve shareholder returns. It could also lead to more M&A activities that will benefit the investment banks. And last but not least, Trump is also talking about lowering corporate taxes. That could actually help to improve overall corporate profitability and increase CapEx spending. And that would be beneficial for the industrial sectors as well. So beyond the big tech, I think take a look at the banks and industrial stocks within the U.S.
I see. Lots to watch indeed. So banks and industrials, as you mentioned. Thanks so much, Eddy. That was Eddy Loh, Chief Investment Officer at Maybank Group Wealth Management. Thank you so much for joining us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.